I'd like to thank everybody for getting on today. Today, I want to talk about the power of life insurance. I think life insurance is probably one of the most misunderstood financial tools out there, but I also think it is, the Swiss Army knife of planning. It can accomplish so much if properly designed. The problem is most people just don't even have an understanding of what it can do. If you think about life insurance, compare it back to your cell phone. And as you think about that cell phone, think about the first cell phone you ever saw or ever owned, and think about what these cell phones can do today. I mean, they're little mini computers that walk around in our pocket. It's evolved. Life insurance is very similar to this in that life insurance over the years has evolved from purely a death benefit to something way, way better. If you think about it, we have term insurance. Term insurance is short-term renting. It solves the need if you just need death benefit for a very specific time. I need it, for the next 10 years to cover a debt. I want to make sure while I'm, starting to my family, my business, whatever, cash flow may be a little bit tight. So I've got that death benefit to cover those needs. Then if you think about we move into whole life. Whole life is a very good product. It's our old product with a lot of guarantees. Pretty much what you see is what you get as long as you fund it like you were supposed to. Then we move into universal life. The problem with whole life was very rigid. It still is very rigid for the most part, but people wanted something more flexible. Think about it, whole life's a box that you can't get into. Universal life is a box you can open it up, move things around, and really accomplish what you want to. From universal life, guaranteed universal life, move to variable life. There again, people said, hey, I want bigger returns. I want to be able to match my stock market returns. Well, that's good until 2008 happens. And so if it's not managed, you could lose 40, 50, 60% of your value like we saw in 2008. And, that's good for some people, maybe not good for everybody. So, index life came in. Index life took the good of a guaranteed UL, the upside of a variable UL with a floor. So now you have basically you've got a cap on your growth. You can maybe have a cap of 10%. So if the market does 10, you get 10. If the market goes negative 10, you're going to have a floor of 0. So you don't earn anything in your interest account for that year. And so it creates a lot of opportunity to plan what product do you want? How do you want to be, crediting your growth in there? Do you want to take risk? No risk. And finally, the riders. This is where we're seeing a lot of growth in the insurance industry today, because this growth in the riders, we have long-term care riders or chronic illness riders. Basically, we can accelerate that death benefit income tax free to help you cover your long-term care needs if it happens. So if you can't do 2 out of the 6 activities of daily living, we can accelerate that income tax-free death benefit and use that money now to take care of your long-term needs. So what I like about life insurance, you can start looking at, do I need more death benefit? Do I want more cash value access? Do I want to grow it, with more risk, less risk? And finally, do I want to add other riders that are going to give me some opportunities for planning? What most people don't know about life insurance, it really is so much more than the death benefit. It can just be death benefit if that's what you need, but if you need more, that more what if to cover your future needs, life insurance is that Swiss Army knife of planning. If you start looking at it, when we design a life insurance policy, we want to make sure we understand what our clients are looking for. If I want maximum death benefit, well, I'm usually going to say maximum death benefit with the least amount of cost. So I'm going to drive down that cash value number. I'm going to expand out the death benefit so I can minimize my cost in this policy as much as possible for the death benefit that I need. The reverse can happen. Let's say you're with your client that wants to maximize cash value. If I want to maximize my cash value, I want to drive that death benefit as low as possible without violating the modified endowment contract line. If you violate the modified endowment contract line, then the policy during the lifetime is going to mirror what an annuity does. An annuity, if you pull money out, you take out the taxable portion first, then you get your return of basis. If it's a life insurance policy, so you're staying 1 penny outside of that modified endowment contract line, you can now access that cash income tax free. You can take loans income tax free. Basically, you can have a policy, cash value is growing tax deferred. You're going to access it tax free during life. And then when you pass away, it's an income tax free death benefit. And if you wanted estate tax free, you can move it inside of a trust. So there's a lot of planning, but we have to understand what the goals are for our clients. So if you start looking at an insurance illustration, here's the flexibility that we have. The first thing to look at is our flexibility in premium design. You know, if you think about a qualified plan, in a qualified plan, there's limitations in how much you can put in. In a life insurance policy, it changes. It's how much do you want to put in? We can design that policy around the premium that our client can put into the policy. We can also pay this as short as a single premium, and we can also design it to be paid for the rest of their life. So here's an example of one that's paying for 20 years, $25,000 a year for 20 years. That's it. No more premiums going into the policy. We just need to understand what our clients' goals are so we get the premium design correct. Then if you look at the next part of it, it's access to this cash value. If that's a concern for our client, you'll see this, you know, for tax-free retirement planning, what if planning. Do I want to build cash value inside of this policy that is growing tax deferred, that you can access tax-free anytime you want? We know, like in a qualified plan world, if you access a qualified plan before age 59 and a half, you pay the tax plus a 10% penalty. Here, you can access the policy's cash value anytime you want. And if you don't touch it, it'll just be paid out as part of the death benefit. If you do need it, it's there. So it's your choice. Finally, that death benefit portion, and the death benefit, there again, a policy, life insurance policies, death benefit is, for the most part, income tax free. Now, you can violate it. It takes a lot to do that. If you want it estate tax free, you want it income and estate tax free, you can move that into a trust. And if you want to put it in a trust and still have access to the cash value, just do a life insurance trust, move the policy in there, put in spousal lifetime access provisions, and your spouse, the beneficiary of the policy, the beneficiary of the trust, can access the cash value tax free as well. So we can create a lot of benefit here with this policy, depending on how we want it designed and what goals we're trying to accomplish for our client. As you start looking at a policy, design is crucial. Take the time to understand, what is it your client's trying to accomplish? Is this one where we just need death benefit? Is this a client that needs cash value? Is this a client that's looking for long-term care benefits? All of these can happen inside of one policy, and I'll give you one planning concern here. You may have competing goals. If you have competing goals, you may want to design two policies versus one. Policy A for death benefit, policy B for cash value access, and maybe cash value access and long-term care riders. So as you think about your clients and what you're trying to accomplish, take the time to understand what they want, understand the different types of products that we have access to, and take the time to get the right design. I appreciate everybody getting on. If you have questions, feel free to reach out and we'll talk again next week. Thank you.